Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders. Welcome to the How to Make Money Trading Stocks webinar. Joining me today from Dallas, Texas is Mike Traeger. Hi, Mike.
Hi. Glad to be here.
And so, hey, Mike, I am really excited about your presentation tomorrow for the Bay Area Moneymakers.
Yeah, it should be interesting. It should be fun.
Yeah, if you're not a Bay Area moneymaker, you can join or get a recording of that simply by you can do a one-time monthly dues, and Mike is going to be presenting on, and you might think that this is an interesting topic considering the strength that we've been seeing in the market over the last few couple of weeks, but Mike's going to be presenting on how bull markets die or how they end, and is it different this time? I think that's always a good topic and something we need to be aware of. I've seen your slides, Mike, and I'm really looking forward to hearing what you have to say tomorrow.
Good. Yeah, good. I'm getting up for it.
And so, okay, I want to remind everybody that what we do here is the mid shares represent are for trading purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. Michael Bishop is celebrating his brother's birthday today and is not with us. At Active Trend Trading, I'm very much about training. I'm very much about helping people, helping traders be able to work a system that they can, they can work around their full-time employment. Last week we did a session on Fibonacci, the secrets of Fibonacci retracements. This week we're going to be talking about March 9th, which is Wednesday night, how to use active trend trading oscillators. This is going to be basically, it's building on what we've started about 2 weeks ago, where we're looking at reversion to the mean type of trades and how that all pulls together. And so we're going to be doing that, and I'm going to do one quick thing. So, there we go. Now, when that hits the airways, it will be at least spelled correctly. This week, what are we looking this week? Very interesting. One of the questions that I keep asking myself. Okay, this relief rally has come up off the bottom, almost straight up, had a little bit of a pause midway, and then continued. The last 3 days have been almost a vertical ascent, and so the big question I have, we are still in a relief rally within the context of a longer-term downtrend. When we see the charts, we'll be looking at that. So is the relief rally at the end of its leash? And we can potentially expect some kind of a snapback or a reversion back into the moving averages. The S&P is pushed into new higher levels of resistance. It is the strongest of the 3 indices that we track. Let me get my pencil going here. The NASDAQ, earlier today, at least the NASDAQ, and over the last couple of days, the NASDAQ had appeared as if it was stalling. It was really struggling to push much higher than what it had already achieved. And then the Russell, while the Russell has been coming off the bottom fairly strongly, it is hitting higher levels of overhead resistance. And so as we sit today, currently, market is still coupled to oil, which depending on who you listen to about the oil market, some people are saying, that this is just a dead cat bounce with oil, and with the glut of supply that is still out there, even though production has been slowed dramatically, that oil is going to potentially revisit its lows or even go lower than the $25 range. Interest rate expectation. Mike, I still can't get used to the celebrations that go on at the Fed and other places when only 250,000 jobs were supposedly added to the workforce. When back when we had healthy recoveries, we were looking at 350, 100,000 more jobs, 350 to 450,000 jobs. And so our expectations as far as economic wise don't you think that it's been dramatically reduced from what it was, say, 7 years ago?
Well, yeah, we've 7 years ago we started to bounce pretty hard off of a bottom. So you had a lower base to bounce off of. Well, now, these numbers don't have as low a base, and they're not coming from them, and so the expectations have become a little more muted.
Yeah.
And you're in the game now where are expectations being met or not? And if so, how is the Fed going to react to that?
Yeah.
And that's in a nutshell, that's the game. And that kind of sentiment is a lot of what's driving the market on a daily and an intraday basis.
And the Fed meets this month on March 13th and 14th. They report out on the 14th, and we'll know whether or not they're going to be compelled to raise rates again. The bets in the market right now are that that they will not. They will be accommodative to the economic conditions. Gino brings up that the jobs seem to be primarily the low-paying jobs. And yeah, it's just, it's really interesting. And there's a series of economic bubbles that are going around in the country itself. Mike, I really liked that article you shared with me from David Stockman. Well, I don't like it because I live in the Bay Area per se, but he was talking about these bubbles like in housing that are in certain areas of the country. Because I know, like out here in where we live in, close to the Silicon Valley, the value of houses right now is absolutely crazy. And David was basically indicating that some of the bubbles with regards to debt and all that, and housing, and especially tying the housing to the tech companies that are out here in the Silicon Valley, that many of these guys buying these really expensive houses based on salaries from companies that aren't even producing a product yet. That could result in a bubble that would be worse than either 2000 or 2007. Is that what the essence of his article was?
Yeah. I mean, it's good reading, even if it's not going to make you, find your next trade. On Valley, is prone to these boom and bust cycles. I mean, it doesn't seem that long ago that everything was about as depressed as it could be, and people were moving out of the area because they couldn't find work. Yep. And now, just literally just a handful of years later, I mean, that particular pendulum has swung to the opposite extreme, and that's just the way that economy and seems to work. And if it's gone this far to the upside extreme, sure enough, it'll just like day comes after night and the sun comes up in the morning and it goes down in the evening, there's going to be a swing back down to the downside, and you might be starting to see just the very early stages of that beginning to happen now in real time.
Yeah. And so, yeah, I know in David's article, he basically stipulated and said that he's forecasting out there and he's expecting all this really, really bad stuff to hit sometime within the next 18 months or so. So if you own a house in the around the Silicon Valley of California, it definitely is a seller's market right now.
Before I moved here to Dallas, a little over 3.5 years ago, my wife and I lived in Cupertino, and we were renting, and we left Cupertino to come here, and so I saw a documentary just a couple months ago about what's been happening with Cupertino
Yeah.
home prices, which is just shocking. It's shocking, and it's stunning, and it's an absolute bubble, and it's unsustainable, and it won't last, and it won't resolve itself well, because it seldom does.
Yeah, and those kind of bubbles are scattered, like I said, throughout the country. Because in some places, hey, there are areas. It's kind of like microclimates. Some places are doing exceptionally well. Some places are not doing so hot. The equal spread of this supposed, uptrending economy has not, equally spread itself across the country. One thing I just want to remind everybody, I've highlighted a couple of times now, is that sometimes these short-term uptrends within a longer-term downtrend can be significant moves, and I think we're kind of seeing that over the last couple of weeks. As a matter of fact, some of Mike's studies showed that basically some of the largest, short-term uptrends in the indexes happened when the market was actually in a bear market. So that's what we could be seeing right now.
Yeah, in fact, if you go back to when things were selling off really hard in 2008, and I remember, because it was just a couple of weeks ago, I was looking back at some charts. There was a particular day, and I don't remember the date. There was a day in October of 2008 when things were really getting volatile and kind of bloody.
Yeah.
And we talk about this move in the indexes approximating about 10% off the lows of just 3 weeks ago. There was a 10% move to the upside in the indexes in one day.
Yeah, one day.
In one day, in October of 2008, and literally the S&P closed at approximately 900 one day and went to the next day, and everybody thought that was it, and the selling was done, and within a few weeks, the market was back to putting in lower lows. So I'm not saying that that's what's going to happen now.
Yeah.
But the perspective is, as you said, Dennis, with the kind of volatility you get in a downtrending bear market, you're going to have some amazing moves to the upside within that overall downtrend. And it's happened before, and it's happening again.
Yeah, history does have a tendency to repeat itself. On the stocks above the 20-day moving average in the NYSE, last week we had broken into territory we hadn't seen in, about 6-7 months. Well, guess what? As of today, we have actually pulled into territory. I mean, the percentage of stocks above their 20 as of when I took the snapshot earlier today was sitting at 88.63. Now, this is not a this particular oscillator that we watch does a much better job of predicting turning points on the bottom of the markets rather than on the top. All this is telling us is that, hey, there's a, the market is definitely in a rally mode, and again pushing up here where it's 88.63. That's, I don't remember it getting much higher than that, Mike, in the research that we've done on this going back to 2002. But this only paints part of the story. So yes, it is extended. As we see, the indices are extended away from their moving averages. The thing that is kind of interesting to me is that the percentage of stocks above their 200-day moving average on, measuring the same bucket of stocks, actually rebounded from the beginning of the year and is back up above the 30 level. And we don't use this as any kind of trigger type aspect, but it is rebounding. And still 65% of the stocks on the large, NYSE are below their 200-day moving average. And so part of what that tells me, Mike, is that the 20-day moving average was extremely, a long way below its 200, which we saw on the charts. And so right now there's a bunch of stocks, since almost 98% of them are now above their 20-day moving average. There's a bunch of stocks that are in that area between the 20-day and the 200-day. Excuse me just a second. There we go. So, and what's your inference from that, Mike? Is just that we're in that, the market, yes, is trying to rally, but.
Well, the market certainly has rallied, and there's been pretty broad-based participation in the rally. I mean, the number here on this chart, stocks above the 200-day moving average at 35, still seems relatively low. And we're looking at a monthly line chart here.
Right.
But keep in mind, if you were to look at this on a daily chart, it was only 3 weeks ago that number was down around 15.
Yeah, exactly.
Tells me that there's a whole bunch of stocks that have come up and cleared above their 200-day moving average, but from an low starting point.
Yeah, and so, yeah, Scott, we'll be getting to the Fib retracement on the chart of the SPX, and as the market has continued now to climb a little bit higher, with no signs of reversing yet. Some clues are starting to fall into place, but still no signs of reversal yet, so we're not in a shorting mode as of right now. So, but anyway, so moving on, like you said, Mike, it's a large percentage of stocks have in fact rallied, and some of them have rallied very nicely. And it's interesting, as I look at the charts, some have rallied 15, 20, 25, and even up close to 30%, and are still confined within their downtrend.
Yeah. Well, that's a true picture of how oversold things had gotten. You're absolutely right. I've seen some charts of individual stocks that are, in 3 weeks up 30% off of the intraday lows from 3 weeks. And again, a 30% move in a matter of 3 weeks is a pretty unsustainable move. But anybody who's been able to catch a piece of that, should be, thinking about at least booking some of that profit at this point. I would think. Yeah.
So here's where we are still down for the year on each one of the indices, and the Russell has pulled out of bear territory. It was, when it was down below 20%, it was in bear territory. It has pulled back above bear territory. The indices are up about 1 to 2% from where they were last week. Some are pushing maybe about a little bit over 2%. The Russell itself is up about 3% from where it was last week, and so it definitely, again, still down for the year, but providing a healthy, nice little rebounding rally, relief rally, as we speak. So as we speak, let's take a look at some charts. Okay, now we had a fib box that was drawn in here from this high to this low, and it basically identified this area from about 1975 down to about, let's say, 1820, a little bit lower than about almost 1900. With this middle section here, this 100% line right now was the middle of the fib box, and as you can see, we pushed up, found resistance there. It looked like we were going to failed breakout earlier in the week, and we started the sell-off and then bam, we get a downturn on the momentum. So everything's looking okay. This is all good, and it looked like okay, we're going to head back down and retest down in this area down here. However, on Tuesday, we get an immediate reversal the next day, blow up through this 1950 level, and want to show everybody that based on the training we did on Wednesday night, we now have once you break out of a fib box, I drew a new fib box that came from, or not fib box, but Fibonacci retracement that went from this high to this low, and then we retraced 100%, came down, rebounded, came down a little bit, and then broke back out, and we've hit the preliminary target off of the retracement, which would be the 138.2% extension. Now, is that extension going to hold? Let me take a sip of coffee here. Do something for this throat. Is this extension going to hold? If we, in fact, do close above this level, that increases the probability that we will go ahead on up and touch off of the 161, the next extension point. As Mike and I was saying, this move from here to here, from this low up to this high, okay, we have in basically 16 trading days, the market has moved, the S&P has moved 10.74%. Now, Mike, that's out of the ordinary. I mean, that's a year's worth of move, or a year's worth of move on the S&P, and it's all happened within just a very short period of time.
Yeah, absolutely, it's out of the ordinary.
And then on the daily charts, one of the things that I'm noticing, this move here from the bottom Tuesday up to the top, okay, we're up 3.53% in 4 days. But one of the things I'm noticing as a potential clue is that, look here, our momentum has actually started to back off. That oftentimes is a precursor kind of clue that that the upswing is starting to run on vapors a little bit. And even though the TSI is starting to is continuing to push a little bit higher, up here at the plus 50 level is typically where it tends to top out. On a weekly chart, what we're looking at, yes, we're still getting a good turn off the bottom, but we're approaching the zero line, which on the TSI, again, approaching the zero line on the momentum. And if the downtrend is to be maintained, then this zero line will be respected. It may push a little bit above it, but then it'll drop right down around it. It's interesting to see, okay, up at this 161.8, clearly the S&P could reach that, if it stays on the same tear that's been on the last 4 days, it could reach that within 2 or 3 days next week. And then what's going to happen there? Where's the next level of resistance? Well, we've got resistance on this downtrend. And, for this to be considered a longer term downtrend, we'll have to take out first this level and then take out this big swing high up here on a weekly chart. And I think, Mike, on our Wednesday night talk, you said if we get up in this area, that's when you would consider changing posture on the S&P. Yes?
Yeah, that's true. If we get back up and can definitively close above the the all-time highs here that were put in last year, you just have to, even if you don't believe it, you have to acknowledge that the bull market is most likely back in play.
Yeah. Even though in reality nothing has changed that much, stocks are still overvalued, correct?
More overvalued now than they were on January 1st.
And so isn't that interesting? Even though after a big sell-off that we've had, the stocks are more overvalued today than they were on January 1st. And eventually this overvaluing, and I said overvaluing will come into play. I want to pop up real quick, Mike, I know you like the longer term charts. And I'll get rid of that. Okay, I keep talking about and comparing this back to the 2009 timeframe or 2008 timeframe, where we, stocks broke down. We had a cross of the 8 and the 20 week moving average, monthly moving average, but then prices actually pushed back above in the May timeframe, and we may be seeing a little bit of that right now. But overall, it then pushed up above, and so, but there was like 2 or 3 months of good upside push until it got back up into close to these moving averages, and then the moving averages worked as a level of resistance eventually, even though we get a push above it. It Pinocchioed its nose above the line and then fell back down in the June time frame.
Yeah, that's absolutely right. And if you go back to 2007, 2008 there, and you look at the wicks on those monthly candlesticks, the lower wicks,
yeah,
and you can see, the levels that the indexes sold off to and then bounced back up to, test the moving averages.
Right.
And if you drew some long-term trend lines in there, you'd probably find that trend lines had been broken, but then were being tested from below.
Yeah.
And failing, and then things collapsed, and pretty predictably. We could be seeing the same kind of thing happening here, and we're not going to know until some more time passes. But yeah, the setup is very similar.
Yeah, and the one thing we need, again, remember this on both a daily, intraday, daily, weekly, monthly charts, is we need a candlestick that that is telling us, saying, okay, we are going, let me get this, move this over a little bit, give me one more blow up. And the candlestick I'm talking about is this one right here. On a monthly, that was a nice little move up for the month, then went back into this overhead resistance up here, the lows from these candlesticks, and then finally closes in the bottom half for the month, and that's what would be called a shooting star, which is a bearish candlestick reversal. And then sure enough, the month of June, you pop up just a little bit to retest this resistance line and then start the sell-off, and that led to the larger sell-off. Is that what's going to happen this time? Time will tell. And so, but that does do a good job of identifying where we would expect things, to potentially happen. Let's go back to, now let's run over to the NDX. Okay, NDX, very interesting pattern on the NDX. We've had now 1, 2, 3 consecutive days of hanging men. That's assuming that, we're not at the close yet, so we don't have a total perfect picture of what today's candlestick will be. Well, hanging men are considered bearish reversal signals. Where are they running in? Where are they performing these hanging men? Right at a strong level of resistance, which is the 100-day moving average, just above the 20-period moving average here on a weekly chart. Again, where's my drawing? There it is. As you can see, momentum daily, sloping down. And one thing that I noticed, Mike, is the momentum on this one is sloping down even at a greater degree or a greater slope than the S&P itself. Again, that bears out the S&P is acting a little bit stronger, but clearly on the these 3 candles here are stalling like candles. Now, if we do sell off later in the day and this breaks back down and it happened to close towards the bottom of today's, towards the bottom of today's range, it would actually be a bearish engulfing of these two candles here, which is clearly a candlestick reversal signal. You got anything here on the the NASDAQ, Mike?
No, I think those are really good observations. I mean, those lower wicks on those hanging man type candles will tell you, even if you don't look at intraday charts, that during the day on those days there was some attempt at selling, and those selling attempts were rebuffed by the end of the day by the close, but there was some selling pressure going on, which turned itself around somehow, and it's an indication that this rally, as sharp and V-shaped as it's been, is starting to get probably a little bit tired.
Yeah, and I will point out, look where it comes to on all 3 days, basically right to the level of what was resistance now, and once it is broken, it then becomes a reversal of rolls, and this past high now becomes the level of support. Now, if we break below that and also break below the 8-day, then that might set us up for at least a pullback to the 20. But right now, and I commented about this on one of the market updates, this speed of ascent as measured by the 8-day moving average, I mean, that is at a angle that is in fact very difficult and challenging to maintain. We'll see, and so, but it without there being some kind of a respite before moving higher. This may be the respite, because that's the other thing that this could be. While yes, they are bearish reversal signals, if those signals are voided, then the NASDAQ could in fact rebound. And where's some of the next targets we could be looking at? Well, the 440 level, but in particularly up here at about the 4480 level, which is where this swing low from this predominant top here, where that rests. And so,
you talk about the rate of ascent here being problematic, and if you look at January on this chart, and the steep sell-off that we had the first few weeks in January,
right.
It was a similar slope, but to the downside.
Yeah.
And I'm trying to reinforce your observation that when things are happening that fast, and the ascent, the angle of ascent or descent is that steep, at some point it just has to stop. It can't be maintained, and we can see that it did stop here on the NASDAQ at some point, and when you see that kind of angle to the upside, well, you're going to get a similar type resolution, at least in terms of a period of consolidation, before any further significant advances really can be put in.
Exactly. And I bring up the 3-time leverage TQQQ, which is the index ETF for the NASDAQ 100. And one of the things, if you're with our Wednesday night training session a couple of weeks ago, where we're talking about reversions to the mean, is that what one really great trading mechanism that a person can utilize is when, and this is a 10% envelope away from the 20-day moving average, when the prices extend up 10%, and this works on, it doesn't work on the indexes because they very seldom get 10% away from their 20-day moving average, just because of the magnitude of their daily action. But that's one of the things that I discovered as we were preparing for that presentation, that while the indexes themselves don't get close to the 10% above or below the 20-day, their 3-time leverage ones do, and often they can be predictive of where to anticipate a potential turnaround. So when we came up, we touched, and what are some of the rules we studied that evening was, well, you get a breach, and then you wait for a reversal signal for a potential trade. And so one could say that on TQQ, we have reached it, and now we're waiting for a solid reversal signal for at least a pullback to the 20-day moving average. That's the essence of the idea behind the reversion to the mean trade. We can throw up UPRO, which is a 3-time leverage index ETF for the S&P. Well, look what it's doing. It is approaching these levels of these past swing lows. It's getting close to them. As a matter of fact, it's in the resistance zone for these levels, which the S&P would be also. And what are we doing? We have touched, but we have no reversal signal yet. And so it's just something we want to monitor this, because this idea of reversion to the mean works both for the index ETFs, especially the 3-time leverage index ETFs, and it also works for individual stocks. As a matter of fact, on your growth stocks that you're looking at, is if you've got a stock and it's just meandering, 1 or 2% above from the 20-day moving average, I mean, it may be a slow and steady gainer and all that kind of stuff, but you have to ask yourself, is it providing enough, range per day that I want to spend my time trading it? And that's a decision every individual has to make. So yeah, it was kind of a nice discovery, Mike, after we prepped for the reversion to the mean, to find that you can throw the 3-time leveraged in, and it actually does in fact breach the envelope, and then wait for things to happen from there.
Yeah, well, I think we also mentioned that, with the leverage on these things, they're a little bit more volatile than the indexes themselves.
Yeah.
And so you see, somewhat more extremes on the charts.
Right.
I think.
And so, and with that said, at the same time, though, they are pretty indicative of where they can be taken in consideration for some clues for the individual indexes, which is fun. So let's take a look at the Russell. The Russell is okay. Russell, you talk about a straight up off of the ground. The last 3 days, the Russell has gained almost 5% in a 4-day period. Now, of course, the Russell had been down more than the other indices, because it was, afraid of the impact of the impact that was going to be taking place with the increases in interest rates. But it has now broken out and has been on a tear the last 3 days. However, what do we see? Same type of thing. Is this a clue that that there is a kink in the armor? Everything is very extended on the Russell. Also, a real quick move up off the bottom on both cases, and so it looks like it's approaching a level of resistance here, where we would think, okay, that's a good place for it to slow down at least and basically digest its gains and/or roll back over. Let's take a look at the Fib retracement from here to here. And as you can see, we have just broken above. That's from this swing high to this swing low. Price action has just now broken above the 50 this week, and actually broke above it and closed above it yesterday, and now we're adding to the gains today. And so very interesting. Utilizing these fibs for potential trades works fairly well. In that, with the recognition that once a level is breached and you get a close above, the likelihood is very good. The probability increases dramatically. You will go at least to the next level, And so, how far are the levels apart? Well, in this case, they're about, for this particular move, about almost 3%. And so be aware of, one of the things if you're going to be using fibs is be aware of the percentages between the fib levels. That can be very beneficial later on. You got anything here, Mike?
Yeah, well, the one observation I would make would be to look at the weekly chart. And since we define a downtrending market as one that is putting in lower highs and lower lows, we certainly have that here on the weekly chart of the Russell,
right?
Which is a little bit stronger than the daily chart. And in the overall scheme of things, despite this remarkably strong rally the last few weeks, as in any downtrend, we are rallying back to a lower high.
Yeah.
And certainly have a significant ways to go to take out the previous lower high.
Yes. Yeah, I mean.
So I think, some perspective is warranted that way. Not unusual in any time frame if you were to put a Bollinger Band or a Keltner channel around the 20-day moving average on a weekly chart, that you get kind of oversold and you rally back to the middle of the channel, which would be the 20-period moving average. And that's what we're seeing here on the weekly chart of the Russell.
Yeah, without a doubt. And one of the things that, if this current uptrend is to continue, what we'd like to see is some backfilling, and there's been very little backfilling here. But another clue is to come down. This is a large weekly candle. Is come down to the midsection of that large candle, and I would go in and actually do the math on it. High, low, add the high, low, divide by 2 to get me the exact precise point where the midsection is. And I would be watching next week for any type of a potential pullback into this area. For a rebound, because if it are, you could even make it, if it falls down below the 50 and then retakes the 50, that would be my trigger to get in. Because, even if we get a reversion back and it gets up here close to the past high, what are we looking at? Okay, that is about an 11% gain. And so I'd be looking at trading TNA as a second chance entry into TNA, and that would be about a 33% gain in TNA. And just that's the way we would want to size up our second chances in that particular case. Does that sound good, Mike? Yeah.
Yeah. Before we leave this, can you go to an IWM chart?
I can
for one reason.
I can go to an IWM chart. I can multitask. Yeah, Joe, we'll look at MD in a bit. Go ahead.
Well, the reason I wanted to take a look at this was to get the volume showing.
Yeah.
And on the daily chart, if we look at volume, and you can see this on all the indexes and all the index ETFs. I mean, this whole rally we've had, especially this past week or so, this nearly vertical ramp has been happening on lower and lower volume.
Yeah.
And in and of itself, that kind of relationship, rapidly advancing prices on declining volume constitutes a divergence. In this case, a negative divergence.
Right on.
In and of itself. And very often you see situations like that resolving itself. In this case, to the downside at some point, and maybe not in the too distant future.
Yeah, I mean, just imagine this. Those of you who have done any aviation. So when is it time to go short IWM, UPRO, TNA, or TQQ? Well, Tracy, that's a great question. And basically, is we wait for a reversal signal up here. Because these 3 days here, have not been reversal signals, but it's been basically push up on lower or descending volume. This was a reversal signal, but that gives us our second. If this is our first clue, first two clues that this uptrend is suspect, then waiting for a reversal signal in the price action itself is the next clue to step into place. And right now we're not getting that, which is just the little hair that I have is being pulled out of my hair in my head as I'm waiting for this thing to do its turn. I want to do one thing. That was a great question. Mike, let's just take a real quick look at the SPY, which of course is the non-leveraged ETF for the S&P, to see if we're getting similar action. Yeah, look at this. The volume on the SPY is falling off.
Yeah, even more noticeable on the SPY.
Yeah, even as we are pushing up and making new highs. And so again, it's we're not going to, if we would get a good proper long side setup, which have been few and far between on this sucker, that would be fine to go ahead and take that long trade. But again, we're waiting for signs of a reversal signal, which has not happened yet. Now, and then the question we have to ask is, will the reversal signal, because they don't happen on every index at the same time, and so we may get the first one here on TQQ, or not TQQ, excuse me, on the NASDAQ. Here's what's happening with the QQQs. As you can see, just this hanging man thinks keep going. Yes, we are looking like we're going to close above the 100, but again, volume is declining. And to highlight the point Mike is talking about, from these lows, which corresponds to, see if I can draw this a straight line, about there, once we started to push up, we're actually getting a decline in volume. And this is partly what's causing the decline in momentum. That's one of the things I like about the momentum indicator, because it does take the volume behind the moves into consideration also. But we have not seen anything happen yet with the TSI. So great point, Mike. Thank you, man. So are you guys glad to see Mike on the webinar this week? Yeah, okay. Good. Yeah, me too.
The only time I'm not here is either I'm traveling or I'm playing tennis.
Yeah, no, good comments. Yeah, I love working with Mike. He and I, we actually get into arguments occasionally, and that's really something fun to watch. But we try to keep it off the air.
Yeah, we do.
And so, okay, let's see. I think that covers everything. But if you do use the Thinkorswim charts, as you're aware, yeah, the indices do not have the volume on it. So that's where you can bounce over here to the non-leverage index ETFs to see what kind of volume they're getting. It's not a direct one-to-one comparison, but it is can give you some additional insight into what's going on. So let's.
One last comment before I have to take off for today, Dennis.
Yeah.
And go back to the chart.
Which one?
Previous slide. One of the index charts. Okay. There we go. Yeah. Just sort of a final observation. And I know that it seems like we're talking about it, in hindsight, and that hindsight's always 20/20. But we were talking about it in real time at the time too. But please, to everybody listening in, when we start to get like we had here 3 weeks ago, where we're putting in a lower low or a double bottom, we're getting positive divergences, and the price action has gotten this far removed away from even the 8-day moving average.
Right.
I mean, to consider the next time you see that, and I can guarantee there will be a next time, even though it's a little bit too late for this rally, please consider taking action. If you weren't able to do so this time, the next time it comes around, do it, and do it in a way, in a position size that almost makes you uncomfortable.
Yeah.
Because you'll wind up being glad that you did.
Yeah, because Mike and I were talking about this particular one. He was in LA taking care of some family stuff, and I was out and about also during this time frame. And we came in after the fact and went, well, crap, look at that as a really nice setup. Even though the individual candlesticks were not really providing us necessarily a good setup. That's on the indexes themselves. NDX. Oh no, not Notre Dame. Indeed.
Some of those three-time leverage index, three-time leverage index ETFs, excuse me.
Yeah.
From the lows that they reached to the highs that they've put in today, over the last 3 weeks have moved, 30%.
Yeah. Yeah.
And nobody's going to catch the full 30% on those things. But even if you catch half of that, I mean, that can make your year.
Yeah.
And it only takes one of those once in a while, to really make a go out of this trading stuff.
And so, okay, Mike, let's get back into, and so, yeah, Tracy, that's a great question on the EWA. It was not a really good reversal signal here, and we just been bitten kind of up here when we originally got in, and it just was not a solid reversal signal. And then ever since after that, we have not had really good second chance entries to also, to potentially get in also. And so that's why we held off on that particular trigger. So what's the path of least resistance? Mike, you got to make the call on the path of least resistance for today.
Depends on the time frame of the chart that you're talking about. I mean, on a daily chart, shorter term time frame, I mean, obviously the path of least resistance right now is up. On the weekly and the monthly charts, in a bigger picture perspective, I'm thinking, the path of least resistance is to the downside at this point.
Okay, that sounds like a winner. And monthly, and that's a day over on that side. And so weekly and monthly, longer term downtrend. Here is basically some of the profits we've booked so far this year, primarily in Strategy 3. Strategy 3 has, kept us in the game so far this year. Really pleased with that. Again, if you're in the San Jose area tomorrow, or even if you're not in the San Jose area tomorrow, but would like to hear Mike's presentation on how bull markets die, is it different this time? You can join us live at 9 o'clock tomorrow morning, California time. Mike comes on about 9:30 and has about an hour plus, a little bit over an hour presentation on how bull markets die. Be very apropos to what we've done today. And then we've been doing some good refinements that benefit us in the Tesla trade this week on the Strategy 3. And so if you have a group, and somebody wrote me about IBD group down in St. Pete's, I'm more than willing to tap into any group and present a personal webinar for that group via webinar. So please keep us in mind. We'll remind everybody that we basically base our trades on the active trend trading on the 5 pillars of active trend trading. What to trade, when to enter, when to exit, what strategy to use, and what to expect. We base each one of our strategies off of the active trend trading system. And I'm in the process of okay, thanks, Chris. I'm in the process of rolling in what we talked about a couple of weeks ago with the reversion to the mean as potential entry signals also. And if you are watching the recording of this, you can join for a discounted rate for the active trend trading system and or the index ETF early warning alerts. So, hey, thanks for joining us today. And remember, see you next week. keep your egg growing and trade wisely and trade profitably. And so I'm ready to look at some stocks if you guys are. I can look at, I got about 4 minutes before we turn into pumpkins. And so, yeah, Chris, on the St. Pete's thing, I'll, definitely can just need to know when and all that kind of stuff. And if you're the organizer for that group, we can set all that up and send the organizer the link for the webinar and then press onward from there. So let's see here. We want to look at is that MD or MID, Joe? I'm assuming that's MID, Joe, if you're still with us. Yeah. Okay. Again, MID is a mid-cap. This is a mid-cap off the S&P, I believe, 400, and it's getting a similar type of move as all the rest of them. It is still contained within this downtrend, but it's approaching that line very rapidly. Probably a little bit too late to try to get long on it, but let's see what happens when it gets up into that resistance area. Is it going to reverse down and then pop up? And clearly, we need a a reversion or a pullback to around the moving averages or to move sideways and wait for the moving averages to catch up. So that's made a pretty nice move also. NetEase. I have been watching NetEase. Okay, it is trying to base here. If we get any type of revisiting down here in the around the 135 level, Tracy, this is where I'd be interested in it. Or if we push back above the 100 and then come back down and then push higher, because yeah, clearly it is still in a downtrend, which we see that here. But it is doing a consolidation within a downtrend, and we've got, like I said, support down here. Some to a level of support from about 130 up to about 135 is the zone of support on this. So I would be paying attention to this and reverting over to the intraday charts for a specific entry. And while this isn't quite a double bottom type move, it's just slightly above here, the lows over here, but we did get some nice diversion here, positive divergence here when we were down here hitting these lows after earnings. And so I'm keeping my eye on NetEase. And I like it down here at the 135 level for a potential bounce. And then if it breaks down below the 132.15 level, I would be looking to exit HIII. Okay, HIII. Kind of a cup and handle type pattern. I mean, yeah, you could consider that a cup and handle. The right side of the cup is a little bit steep, but it's starting to break out back above this. This was a good entry, but it was so close to earnings, would have been a tough move. But this, well, no, actually, this would have worked out to be a really good entry for a earnings move, because earnings came this day, sold off a little bit. But it's held up nicely after earnings. Downside on the trade, on this particular. It's holding up, but the we're getting some move downs on both volume and momentum, and our weekly momentum, look at that, that's gone kind of like sideways. And when stocks go in and the momentum is not trending, we'll tend to just, move sideways. Well, but we're moving sideways between 120 and about 135-ish. If we push out above the 135 level on volume, that would be a breakout, and then we could use this level of support for bounces. Let's see. Last one. X. Okay, energy. If we're anticipating oil to continue on its rebound, we can, oh, come on, Dennis. We could be looking for a continued bounce in XLE. There we go. Let's draw a trend line down across these levels approximately. And so it's approaching, it is still in a downtrend. Could be moving up into this level of resistance, and we'll see what happens when it gets up there. Is it going to roll over and fall down, because we've had one leg, two legs, and kind of three legs down, and we maybe see some basing in here, because if oil is in fact on a dead cat bounce, we could expect a retest back down here in the 50 level. It's an excellent entity to keep your eye on if you're trying to play this as a substitute for oil, the energy patch. So, okay, folks, that concludes for today. I think that puts us out right on time. Thanks for joining us today, and thanks for your emails. Have a great weekend. God bless.